here's Tuesday, June 22nd, and another big sell-off day today. Dow was down big, S&P down big, Nasdaq down big, and I'm gonna look at some charts here. Alrighty, I'm gonna pull up first here. I'm gonna pull up the dollar sign SPX. And as you can see here, we had the death cross, which happened on Friday, and we've had two closes, well, actually 3 closes now, with the 45 crossing below the 100, which is very bearish. We're still above the 18-day moving average. We had another big tick down in the histogram, and the MACD is curling over now below the zero line. If you have a cross below the zero line, it tends to be a very nasty down move, and the stochastic is now below 80 on the black, 78 and 88, so it is not embedded to the upside. It is just plain overbought, and the momentum is clearly turning down. If I was, it feels very good to be short from this level. Positions are in the money, and you have a lot of overhead resistance. You have very easy get out points. The only real obstacle in the way right now is the 18-day moving average. I'm not expecting I'm not expecting a lot out of tomorrow, just because there's a Fed meeting. I could see the market gapping down tomorrow. If it gaps down 20 points or so, I might actually take out a half the position and wait for a low volume rally back, because the hourly on the S&P is pretty oversold right now. It could stay like that for a little while, but if we got the gap down, I would probably take a little bit off the table and just wait for a bounce to reload some shorts. That said, however, a lot of people are going to be looking to sell the market now. So I would, if you were short, like me, I was actually short from Thursday a little early, because I did get hurt a little bit from the gap up on Monday, but here we are Tuesday, and I'm looking pretty good. So I would not be in a rush to take out, just because you have so much resistance on the upside. And here's another chart I want to show you on the SPY that I've had up for a little while, and it's a broadening top formation. And as you see here, you clearly have you have lines connecting the two lows here, and then you have 3 or 4 times it bumped up against this line. The China news, it popped above, but then it quickly went back under. And basically, with this type of formation, the next time down, you would expect it breaks through, and that is the neckline down here that we're talking about on the head and shoulders formation. As you see here on the hourly, the histogram is still ticking down. The MACD is below 0, but you have some potential positive divergences setting up here. So there could be a bounce. I'm not really anticipating a big bounce. If it happened from here, I couldn't see it going much higher. But what I could see happening tomorrow is a gap down, say of 20 points or so, down to the 108 or maybe high 107s area, and I could see potentially some shorts covering ahead of the Fed meeting, and then the hourly would maybe work its way up a little bit, and then you could possibly reload in the 108 in the 108s. That could be a possible scenario. Another scenario is we just kind of open flat, trade down a little bit, and then just gradually some shorts squeezing into the Fed meeting, and then maybe a sell-off after. But either way, I think the market is in it's in a very bearish situation right now. And if you look at this chart, I showed this yesterday. Yesterday we closed over here. We popped above this downtrend line, and then we just immediately came back under. And then today we traded below the uptrend line from beginning of June, and we really crashed right through it. So volume was accelerating. You can see here, and the volume was very light again. Just my opinion on that, there weren't a lot of bids to hit early on. There was horrible home sales data, and there's just not a lot of buyers up here, and basically there's no one to distribute to, and the market just kind of grinds its way lower, and then as it hits certain levels, then people just start taking out of positions because certain technical areas are hit, and then you get a nice rip down the last 2 hours of the day when most of the damage was done. As you see here, the bearish triple P pattern is confirmed, as you have another down bar in the histogram. Stochastic is below 80 now. MACD is curling over. Just have a lot of negative things here, and of course you have the left shoulder, head, and right shoulder over here, potential right shoulder over here. You have the death cross over here, which I've been talking about, which hasn't happened throughout this whole rally, so this does not happen often, so the odds of this turning back up again are very slim. So you got, as far as I'm concerned, I'm holding my position. I mean, I may kind of trade in and out of it as it gets closer to the 1040 area, because there might be some short covering, and you might be able to re-short 2 points or maybe 3 points higher. But I'm not going to get scared out of the position here, because this is looks like this market is trending lower, and this was just a dead cat bounce in the indexes here. So just keep that in mind. You look at the volatility index. Again, you had the breakout of the bullish falling wedge. Today you had confirmation with another bullish candle. You were up 2.17. It closed over 27.05. Again, confirmation of the bullish triple P pattern right here, and another histogram bar ticking up. Stochastic is still very oversold, so this could have a long way to go, and I'm anticipating it will have a long way to go. Tomorrow you would like to see this cross the 45 and the 18, which is 29.84, and it's coming down. It would be nice if this crossed that, and then the 18 curled right back up, so you never have the cross below the 45 of the 18, which would be very bullish for the VIX, bearish for the markets. Another chart to look at is the US dollar, which I've been mentioning, which ticked up again today. The dollar was only up fractionally, but it was up. You have another histogram bar ticking up. Stochastic is still below 20, so you have some concerns about it possibly retracing part of this move. But you have the 45 days is accelerating to the upside and is provided support yesterday. So you'd like to see it cross that 18-day moving average, but if you're in the bear camp, and like I said, the next 5 days are pretty big in my opinion, because it's going to close out the monthly candles, and they could go in either direction. Like right now, for the month in the SPY, we're only up like 77 cents. So if we start to head down, I would look for new lows in the market in the next 5 days, and that would be very bearish. That would probably mean July is going to be a down month also, judging from what I'm seeing in the charts. It's going to look at Bank of America here, just because the retail sector was breaking down, but the banks they've been weak. They've had basically no bounce, as you see here. They've come down from 1950. It came down all the way to under 15, and it only bounced to like 16.20 or so. But today, towards the end of the day, it gave up the 18-day moving average by 1 cent, closed at 15.58. The bearish thing is, as you see, that stochastic curling over. Its overbought rating 72.76, pointing down. The histogram is ticking down, and you have the MACD has flattened, and it's below to 0. So if you have the bearish cross below here, you could have some big downside in Bank of America. I would have a target of about 11 or 10 if we start to head down. Alright, this is part 1, and I'm going to try to make another one after this.